Hi, and welcome to another edition of Ask Spurrell CPA. Today we're talking about other income and expenses. I am here with Cole. Cole, our resident Calgary Flames fan in the Edmonton accounting office. You're grinning pretty wide. Calgary's clinched the playoff spot, I understand.
Yeah, first team in the West to do so.
I don't know what to think about that. We'll move on. I guess from that, there's nothing else to do but move on other than that. So the quote that we have to deal with here in other income and expenses, these aren't the regular income or expenses. These are other income and expenses. It's a Michael Gerber quote, author of our favorite, The E-Myth. With no clear picture of how you wish your life to be, how on earth are you going to live it? What is your primary aim? Where is the script to make your dreams come true? What is the first step, and how are you going to measure it? How far have you gone, and how close are you to getting your goals? So, Cole, we're going a little bit deep on the accounting show here today, but that's okay. We'll tie it back in. It's other income and expenses. And remember that the statistic here, Intuit, the makers of QuickBooks, they did a survey of small business owners, and they found that 82% of small business owners would get a score of less than 70% on basic business financial literacy items. So less than 70%, less than 70% of the time they know what's going on. Or 30% or more of the time they don't know what's going on when it comes to their financials, which is a problem. The story here that we have is business owners, they're looking to increase the size and profitability of their business, but they don't have a clear picture of what's going on in that income statement because they have what we call other income or other expenses. They're mixed in with the real drivers of that business, and they're completely skewing the income statement. So they don't really understand how their core business is doing. So Colt, what are the questions that these business owners need to ask?
What is the other income and expense section of the income statement?
Yeah, so let's start at the top of what should be on your income statement. You have your revenue items, you have your direct cost of sale items, then you move down to your gross margin. What happens after the direct cost? We pay those contractors, we pay those suppliers that dealt with that job directly, we have our gross margin. Now we have all our overhead expenses, the administrative wages, the rent, the office supplies, the interest and bank charges, and we're going to get to a number called income from operations. Income from operations, because all of those general and overhead expenses, they didn't deal directly with the job and getting the job out the door, but they're part of your core business. We got to have a space to operate. It's the receptionist, but we start getting into the other income and expenses. Now, these are the items that don't deal with the core business. So we're talking about things like taxes. We're talking about the profits and loss from investments. These are items that they don't deal with the core business, the salary that the business owners are taking. They need to be separated from what's happening in the core business so we can get a good idea, what's the profit or loss from the core business.
Where does other income and expenses fit in on an income statement?
Yeah, so it's below. So you get to that really powerful number, revenue, cost of sales, other, you get to the general and overhead expenses, and then you have your net income from operations. That's that powerful number, that net income from operations, how much are you making in your core business. Now we have the other expenses or income. They're legitimate expenses, but they don't deal with your core business, and the rate below that income from operations, so you get that total, that income from operations.
How does this help calculate income from operations?
So it really, if you had these items mixed in, so let's say you have, you run you're a plumbing contractor, you're a dentist, and you have the condo fees for your rental property. And it's rental property owned by your corporation, but it's not part of your core business. That residential rental property does not, help you deliver plumbing services or see your patients at all. It has nothing to do with it. But it's legitimately owned by your corporation. If we have those condo fees mixed in with your other overhead expenses, that income from operations number, it's not really reliable anymore. The same thing. You could have a big gain or loss because you sold a bunch of stocks, that doesn't have anything to do with your core business. I mean, even moving out some of the capital assets of your business, you could have done really well on moving out a piece of equipment that deals with your business, or not so well. But that's a one-time event, really. It's not something that deals with your core business. So having those other income and expenses stripped out of the core revenue and the core expenses, it gets that income from operations number a real clean item that or clean total that deals with your core business.
In general, is it better to focus on net income or income from operations?
Yeah. So a lot of people, business owners, they get the financial statements and they start looking at net income. Let's just look at net income. But often the net income is, there's some things that there's one-time events that can happen, big sale of equipment or an asset, have a bunch of investment income. But one of the big thing is what the owners pay themselves as a salary. So, which often is a tax decision. We're trying to minimize tax with the payment of that salary, or provide for the funds that they drew out of the business. They have nothing to do with the underlying performance of that business. So focusing on the income from operations, that's going to help you focus on the core activities of your business. Often if you want to increase net income, it's just take less money out of your business. That can be one item, or it just can be the decision that the accountant made on what's the cheapest way to pay you out. They paid you in the form of dividends instead of salary, in which case your net income can look much better, but nothing's really changed about the business. It's just the mechanism we use to pay, to minimize tax is different.
Why should your investment income be separated into other income and expenses?
Yeah, that's one of the great examples. So we have investment income. We can have dividends that we're getting on stocks. We can have the interest that we're getting on bonds. We can have the fee that the investment manager is charging us. All of these things do not deal with the core business. They're generally an ancillary investment option, and they're a good thing. I mean, it gives us some diversification of risk. Not everything is in the business. We have some liquid funds, and they're a great thing, but they don't deal with the core business. So we don't want them commingled with those core business revenue items or core business expense items.
Why should rental income and expenses be separated into other income and expenses?
Same thing. It can be really significant, and revenue income can often be especially problematic because it has expenses that, if an external banker is looking at it, if they're not separated, they won't know the difference on the expenses that deal with the core business and the expenses that deal, with the passive investments of the business, if you will. So we really want to isolate those, so we get to that nice net income from operations of the core business. Almost the words that should be added. It's the income from operations of the core business. And then we get the other income or expenses that are important. We need to understand them. They're legitimate income or expenses of the business, but of the corporation, but not of the core business. And rental income are really significant. We have condo fees or a big gain or loss when we sell the property, and it can completely overshadow what's happening in the core business. So we want to be able to make sure that report is still usable to run the core business and make decisions on it.
Why should the gain or loss on asset disposals be put in the other income section?
Yeah, so some people can say these can be gain or losses on passive assets, but they can also be gains or losses on active assets. And either way, I would put them in the other income or expenses, because most business, they aren't buying and selling equipment on a regular basis. It can be very one-time in nature. They're selling a significant piece of equipment at a big gain or loss once every 5 years, once every 10 years, or one time and never again. So you really want to take those kind of one-time events out of your income from operations of your core business and put them in the other income section. It's important to know and understand what the effect of that was, but again, we don't want that number clouding the core business because they're normally one-time in nature.
Should the salary paid to the owners be grouped with the salary paid to arm's length staff?
Yeah, that is probably like my number one pet peeve. Whenever I see small business financial statements, these are notice to reader financial statements, which effectively means we can assemble the financial statements how we see fit. That's going to be beneficial to the users. and putting the owner's wages, commingling it with the wages paid to arm's length employees. I mean, it's just the first thing you do when you're analyzing the business is back out the income, the wages paid to the owners to figure out what does this business make before the owners get paid. Because what the owners get paid could be, a lot less than what they deserve, or it could be a lot more than what they deserve. We could replace them for cheaper, but they're just taking it out because they can, and the business can support it. So yeah, they should always be other income section. Wages paid to non-arm's length parties or wages paid to owners, separate line item in the other income section, not commingled with the wages in the general overhead expense or the wages in the direct cost of labor at all.
How does separating owners' salaries help with financing?
Yeah, sometimes a business can look like it can't support the financing because a banker picks this thing up and says, okay, this business has $800,000 in revenue a year, but it has, $600,000 in wages. Well, little do they know, if they just have one wage item, that $600,000 in wages might include $200,000 or $300,000 to the business owner, and the business owner doesn't need to take that salary. So we go from this business is only making $200,000 and it can support this loan, or we have $600,000 in revenue and $800,000 in revenue and $600,000 in expenses, and let's say the business owner is half of that salary. Well, now all of a sudden this business has $500,000 to support a loan. So separating that can give you a lot more clarity in getting a loan, and we got to remember when you apply for a loan, you can explain this all you want to the banker, your representative, but this is going to go to an underwriter and possibly their supervisor. You'll never have an opportunity to discuss it with them, so you want to make it as clear as possible of what we pay the arm's length employees and what we pay the owners, so they know exactly what's going on in the business.
How does separating owners' salaries help make business more sellable? Yeah,
when we're looking at the value of the business, we're generally looking at what's the normalized income of the business. And one of the first things we do is we're going to back out the salary paid to the owners, because the owner's salary is, completely, it's not tied to the fair market value of what they should be paid. And 9 out of 10 times it's either higher or lower than the fair market value. They're rarely paying themselves at fair market value. They're paying themselves what's the most beneficial for tax purposes, or they should be if they're not. And what you want to do is you want to back out that owner salary, so we see what is the normalized income here of this business, because that's what generally someone's going to buy a business for. 3 to 5 times the normalized income of most small businesses, and they can't get to that normalized income number if it's not separated. And if you've had the historical records where you've been separating the amounts paid to the owners, the buyer is going to have more comfort with this document. They actually know, okay, this is what it's going to cost me to pay the employees who are still going to be here when I buy this business. And the owner comes off the books, and this is how much it will cost to replace the owner, or I'm going to do the work of the owner. And they have a good idea of what they're getting into. And it's a lot more reliable, and there's a lot more chance of a transaction is going to occur if we can separate out. So I think that's all the time we have here today for other income and expenses. Thanks again for tuning in. Please hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And if you have any questions, please put them in the comments below. We'll do our best to address them and potentially do a future video on any questions you put below. Thanks very much.
Thanks, guys.